Hello and welcome to Module 11a. Module 11a is Present Value Fundamentals and it begins on page 331. Now, the purpose of this module is just to sort of like introduce you to different types of present value techniques. It's not really so important to know all the different problems that they give you here for multiple choice questions as to know how they could test present value. You might notice that Module 11, present value, consists of Module 11b, which you're going to do that with me, which is bonds. Present value 11c, which is debt restructure, and then present value 11d, which is pensions, and present value e, which is leases, because they apply present value to specific topics in the CPA exam. But I just want to show you some things that I want you to make a note of for present value here. Just a few multiple choice questions that we're going to go over. First of all, for Module 11a, the multiple choice questions I want you to do are numbers 6, 7, 13, 23, 24, and 25. There's 6 of them all together. There is no simulations. I don't think you need to do any simulations. There are 4 keywords. Let me give you the 4 keywords. The 4 keywords are always found in the back. If you turn to page 339, there's 2 words that I'm going to have you check off, and then I'm going to write a couple keywords for you up on the board. Okay, for the keywords I want you to check off on page 339 on the far left-hand column. I want you to check off disclosure of long-term borrowings. That's disclosure of long-term borrowings. And then they say the next one right below, it's effective interest note. No, I want you to scratch out the word note. It's effective interest rate. It should be effective interest rate. Also, add a couple ones there. It's fair value option, and then fair value election. Fair value election. The fair value option, fair value election, both can be used interchangeably. They are covered under SFAS number 159. We discussed SFAS number 159 a little bit when we did Module 7D, and we'll be discussing them specifically as SFAS number 159 applies to different topics within financial accounting and reporting. All right. The first thing then is just so make sure that you write down these 2 keywords. So you checked off disclosure of long-term borrowings. You also checked off effective interest rate. Scratch out the word note, write rate. Then you wrote down fair value option, fair value election. Those are your 4 keywords, and there are no simulations that I'm assigning here. If you take a look on page 331 of your textbook, on page 331, item number 3, we talk about compounding. Basically, you have to learn to compound. All that means is how many times they stop and calculate interest. If you can compound annually, which means they only pay interest once a year, or you can compound semi-annually. That's most often found in bonds, where you compound every 6 months. Just keep in mind that every time you compound, you increase the number of periods. So if you have a 5-year bond that's compounded semi-annually, instead of 5 years, it becomes 10 periods, because it's 10 6-month periods when you compound semi-annually for 5 years. So just remember that. Also, when you take the effective interest rate, the market rate, when you do the compounding, you have to divide by the number of times you compound per year. So if you have an effective interest rate that's 8% per year, if you compound semi-annually, it'll be 4% per period, per 6-month period. So you have to remember to do that. On pages 332, those of you who had me already for BEC, I pointed out to you the present value tables in BEC when we were doing Module 42, capital budgeting. But let me just, for those of you who haven't had me yet in BEC, I just want to point out to you that in financial accounting and reporting, they can give you 4 tables, but you'll only use 2 of the tables of the 4 that they can give you, and the 2 tables that you'll use are the present value tables. The future value tables are given just to confuse you. So every time you see some table that says the future value table, you can ignore it. What you want is the present value table. What they have here is they have 2 present value tables. The second table is called the present value of 1. The bottom table is called the present value of the ordinary annuity. I'm on page 332. You always want to use the present value tables. If you use the present value of $1, look at the present value of $1 table, which is the table that is the second table down. That table, you'll notice that every single number there is less than 1. Every single number is less than 1. Then the bottom table, which is the present value of the ordinary annuity, present value also being a less than concept. Remember, present value of $1, every number was less than 1 in the table. Present value of the ordinary annuity. An annuity means that it's a stream of equal payments. It means the payment happens over and over and over again. It's the same amount. It's equal amount of time intervals in between each payment. That's called an annuity. You'll notice that every single number on the table is less than the number of periods. That means if you go to n equals 1 period, every number is less than 1. N equals 2 periods. When you go across, every number is less than 2. N equals 3 periods, every number is less than 3 because it's still a less than concept. Also, I just want to point out to you that the present value of 1 and the present value of annuity of $1 are highly related. If you look here, this would be the present value of $1, and this is now going to be the present value of the annuity of $1. Let's just take it for 1 period, and let's just take it for 6%. So this is 6%, 6%. If I go to the present value of 1 table for 6%, the numbers are, that's the second table down, the numbers are 0.943, item number 2, 0.890, item number for period number 3, it's 0.840. If you look at the present value of the ordinary annuity of $1, the number is going to be exactly the same as the present value of 1. Remember, use the present value of 1 when there's only one payment. Use the present value of the annuity of $1 when you have multiple payments. It's a stream of equal payments, but the payments have to be equal. You'll notice that under the present value of the annuity of $1 for 6%, it's the same number here. So these are going to be the same, okay? And then all you're doing is you're adding up these numbers to get the present value of the annuity of 1. So what that means is that, just put this back. If you take this number and add it up to this number on the present value of $1, 0.943 plus 0.890, this is going to give you 1.833. Then you take these three numbers together and you add them together. That'll give you 2.673. If you look at what you have here, under 6%, for the present value of the ordinary annuity of $1, you have 0.943, then 1.833, then 2.673. So if you ever get given, in financial accounting reporting, if you ever get given the present value of $1, and you need to convert to the present value of the annuity $1, you just add up all these numbers. So this plus this equals this number. These three numbers here equals this number. If you ever are given a present value of annuity $1 and you need the present value of 1, all you do is you remember these two are the same, okay? They're exactly the same. And the difference between this one and this one is this. And the difference between this one and this one is this. And that's all it is, okay? So remember, it's still a less than concept. This number is always less than the number of periods. This is less than 1 period. This is less than 2 periods. This is less than 3 periods. Okay? All right. Other things. If you take a look on page 333, item number 7, on page 333, item number 7, which is annuities due, look at the third paragraph down where it says, I'm on page 333, under annuities due, number 7, 3 paragraphs down, it says to convert either a future value of an ordinary annuity or the present value of an ordinary annuity to an annuity due, multiply the ordinary annuity factor 1 plus I. Okay, so you just, to convert an annuity due to ordinary annuity, you divide by 1 plus I. I really, really doubt they'll ask an annuity due. Most of the questions on the exam involve an ordinary annuity. An ordinary annuity means it comes at the end of the accounting period. They may try and trick you into thinking it's like an annuity due, but it's usually an ordinary annuity and what they give on the exam. I'll show it to you. If you take a look, there's one other thing that I want to point out to you. I just want you to review on page 337. On page 337, item number 10, which is about 2/3 the way down the page, on page 337, I just want you to read the first couple of paragraphs, just the first two. They're really, really short paragraphs. The first 2 paragraphs under item number 10, loan origination, costs and fees, You never know. Maybe they might ask something like that. So I just want you to read the first couple of paragraphs, the first two paragraphs under loan origination costs and fees there at the bottom of page 337. If you turn to page 338, I just want you to know on page 338, see where it says item number 12, which is the fair value option. Right above that, we're going to read the paragraph right above where it says fair value option. It says, in the footnotes to the financial statements, a disclosure must be made for the aggregate amount of maturity and sinking fund requirements for all long-term borrowings for each of the 5 years following the balance sheet date. You just got to remember this. There's something magic about 5 years. All right? Maturities for debt, got to disclose 5 years. Sinking fund requirements for debt, got to disclose 5 years. All right? Other types of long-term debt. Capital lease payments, got to disclose 5 years. I don't know what it is about. It's this magical number for 5 years. Anyway, just remember it's 5 years after the balance sheet date. We will go over the fair value option in a minute. But the whole purpose of present value is that generally accepted accounting principles do require that whenever your cash flows go beyond 1 year from the balance sheet date, if it goes past 1 year from the balance sheet date, you must consider the time value of money. You have to. That's what generally accepted accounting principles say. Now, if the cash flows are just for 1 year or less from the balance sheet date, then the time value of money is considered to be immaterial, and you don't have to consider time value of money or present value. But whenever you have any types of receivables or payables, and you go beyond 1 year, you must consider the time value of money. Except when, on page 338, you select the fair value option. Now on page 338, in the middle of the page, item number 12 talks about the fair value option, fair value election under SFAS number 159. That's in the middle of page 338, item number 12. I'm just going to read this to you. It says, as discussed in Module 7D, we did talk about fair value option a little bit in Module 7D, SFAS number 159 provides that a company may elect the fair value option for reporting financial assets and financial liabilities. If the fair value option is elected for a financial liability, the requirements of APB number 21 no longer apply. The requirements of Accounting Principles Board Opinion number 21 say whenever the cash flows go beyond a year, you have to consider the time value of money, and you have to use present value tables. If you elect the fair value option under standard number 159, you can throw that out. Okay, you don't have to do that. Instead, if you elect standard number 159, the fair value option, the financial liability is reported at fair value at the end of each reporting period, and the resulting gain or loss is reported in the earnings of the period. SFAS number 159 specifically does not address the measurement of interest expense. Therefore, a company may calculate interest expense in various ways, but it must disclose the method in the notes to the financial statements and the method used to determine interest expense. Okay. All right. Now, remember, anytime you go beyond 1 year for the cash flows for these receivables and payables, you must consider the time value of money under APB number 21. Except when you elect the fair value option, in which case you just put it on your balance sheet at fair value. You don't have to do amortization. There's no discount. There's no premium. None of that. You only have discount and premium when you follow APB number 21. And remember, you have to make this election when you first initially recognize the item. Okay, let's see if we can take a look at a multiple choice question on this. Multiple choice question number 13. Number 13 is found on page 341. Number 13, found on page 341, says, at what amount should the note payable be reported in Roth's December 31st, 2008 balance sheet? So what amount should they report the note payable on Roth's December 31st, 2008 balance sheet? On December 31st, 2008, the Roth Company issued a $10,000 face value notes payable to the Wake Company in exchange for services rendered to Roth. The note, which was made at the usual trade terms, is due in 9 months and bears interest payable at maturity at the annual rate of 3%. Now, the 3% is not a good value for the interest rate. They say the market interest rate is 8%, okay? Then they tell you the compound interest factor of $1 due in 9 months at 8% is 0.944. At what amount should the note payable be reported in Roth's December 31st, 2008 balance sheet? Okay, how long is this note for? It says this note is due in how many months? 9 months. You only have to consider the time value of money whenever you have cash flows in excess of 1 year. So the whole point here of confusing you between the 3% and the 8% and the compound interest factors for 8% and blah, 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 that's just to confuse you. You do not have to consider the time value of money unless you go beyond 1 year. This is only for 9 months. So, at what amount should the note payable be reported at Roth's December 31st, 2008 balance sheet? You could ignore the time value of money. The note is for $10,000. That's the answer, $10,000. So the correct answer there would be B, like Barbara. What are they trying to trick you? By making you think you have to take the present value, but you don't. You must only consider the present value when cash flows go beyond 1 year. Okay, let's take a look at multiple choice number 6, please. Number 6. In multiple choice number 6 on page 340, it says, I like this one. In December 31st, 2008 balance sheet, what amount should Chang report as note receivables? They want to know what is the amount to report as the note receivable. On December 30th of 2008, the Chang company sold a machine to the Door company in exchange for a non-interest-bearing note requiring 10 annual payments of $10,000. Folks, if they say that the note is non-interest-bearing, that is a lie. All notes bear interest, or else there's no way anybody could stay in business, okay? The note has interest on it. Door makes the first payment on December 30th, 2008. Okay, they had a note first to start off with 10 annual payments. They made 1 payment. How many more payments do they have left? 9. The market interest rate for similar notes at the date of issuance is 8%. There's your interest, okay? They always have interest, or else nobody could stay in business. Then they would probably all need a bailout, right? Information on the present value factors is as follows. And they give you the present value of 1 and the present value of the annuity of $1. The thing is, which one are you going to use? Well, you have $10,000. That's going to happen over and over and over again for the next now 9 periods, because you already made 1 payment. 9 periods. So that's going to be the present value of an annuity, because an annuity is a stream of equal payments. And it is an ordinary annuity, meaning that the annuity comes at the end of the year. Now, I know they make it sound like the annuity is an annuity due and it comes at the beginning of the year, but it's not. If you take a look, by the way, an ordinary annuity is also called an annuity in arrears, meaning it comes at the end of the accounting period. An annuity due is also known as an annuity in advance, which means it comes at the beginning of the year, but they don't really test those on the CPA exam. So here then, they're telling you that they made the first payment on December 30th of 2008. So if they make the first payment on December 30th, 2008, when is the next payment due? The next payment will be due on December 30th of 2009. Well, if it's December 31st of 2008, and the next payment isn't due until December 30th of 2009, that's 264 days from now. You can see that's the end of the next accounting period, all right? So it's really an annuity that's an ordinary annuity or annuity in arrears. It's definitely an annuity in arrears because it comes 1 year from now. So then all we have to do is pick, well, since we know it's the present value of the ordinary annuity of $1 at 8%, because 8% is our market rate, you always choose the market rate when you go to the annuity tables. So we ignore the present value of 1. The present value of $1 is just there to confuse you. So how many periods is it going to be? Is it going to be 9 periods or 10 periods? Well, the note was for 10 years and 10 payments, okay? But we already made 1 payment. So how many payments are left? 9 payments. So when you do this, all you're going to do is take the 10,000, multiply that by the present value of the annuity of $1 for 9 periods, and the interest is equal to 8%. All right, you multiply that by the present value of the annuity, and that's 6.25. 6.25, and this is then going to give you $62,500. Now, how would I write this? How would I put this on my balance sheet? Is this a note payable or a note receivable? This is a note receivable. So what you're going to do is you're going to say notes receivable, face amount. That's going to be 9 payments times $10,000 each. That's going to be $90,000. Then the carrying value of the note, notes receivable at its carrying value, sometimes that's called the book value, is going to be the $62,500. And then the discount on notes receivable is then going to be the 90,000 minus the 62.5, which is, 90,000 minus the 62.5 is going to be minus 27,500. Okay, and that's the way it would appear. And you would always show it at the carrying value of the 62,500. It's the face amount, 9 more payments times $10,000 per payment, minus the discount of 27.5 gives you the note receivable, the carrying value. Now, why do you have to report this at its present value? The reason you have to report it at its present value is because it's in excess of a year. This is 9 years from now, okay? It's 9 more payments, 9 more annual payments. So, let's answer the question. It's December 31st, 2008 balance sheet. What amount should Chang report as a note receivable? The answer is going to be $62,500. So the correct answer there would be C. Now, this is a type of payment. It happens over and over and over again. We learned that that was an annuity. And this other type of note, which I'm going to do, which is multiple choice number 7, you only get paid one time all the way at the very, very end. So let's take a look at multiple choice number 7. Number 7. Now, I know there's a block of questions. I only want to do number 7. You don't have to do number 8. Number 7 says, in Emmy's 2008 income statement, what amount should be reported as the interest income? What amount should be reported as the interest income? So they want interest income or interest revenue. Items 7 and 8 are based on the following. On January 2nd, 2008, the Emmy Company sold equipment with a carrying value of $480,000 in exchange for a $600,000 non-interest-bearing note that was due in January 2nd, 2011. Okay, folks, they all bear interest. Even if it says non-interest-bearing, it bears interest, okay? There was no established exchange price for the equipment. The prevailing rate of interest for a note of this type at January 2nd, 2008 was 10%. Okay, that's the market rate, 10%. The present value of $1 at 10% for 3 periods is 0.75. So why do we have to take the present value? The reason we have to take the present value is because the note isn't due for how many years? 3 years. Okay, so you have to consider time value of money and present value whenever you go greater than 1 year from the balance sheet date. So we must consider the time value of money. Now this is a case where we're going to use the present value of 1 because we're not going to have any payments until the very, very end of the 3 years. There's only going to be 1 payment, so use the present value of 1 for 1 payment. So the way I'm going to calculate this would be to take the $600,000, multiply that by the present value of $1, okay, where the number of periods is 3 and the interest rate is going to be how many? 3 periods. 3 periods and the interest rate is 10%. The interest is 10% and it's 3 periods. Okay. So when I take that at the present value of $1, because it's only going to be paid 1 time at the very, very end, it's 0.75. Okay. 0.75. That means that 600,000 times 0.75. Well, I can do that math in my head. That's 450,000. Okay. So what we're going to do is we're going to do an amortization schedule. Yep. Time 0, time 1. Here you're going to have an interest expense. Here you're going to have some sort of a payment. Here you're going to have some sort of a plug, otherwise known as the amortization. Then here you're going to have the carrying value. On the first line, it's always blank. The carrying value approaches what is owed. What do you owe at the end of the 3 years? You owe $600,000 at the end of the 3 years, and the carrying value is going to be set at $450,000. And that carrying value has got to approach what is owed, which is $600,000. Let's calculate the first amortization line. The interest expense is going to be 10% times the carrying value. 10% times the carrying value of $450,000 is $45,000. What's the amount of the payment in the first period? Nothing. There's no payment. You don't pay anything until the end. That's 0. The plug, or the amortization, is just the difference between this column and this column. 45,000 minus 0. I can do that math. That's 45,000. Now, the carrying value always approaches what is owed. What do you owe at the end of the 3 periods? 600,000. How are we going to get from 450 to 600,000? This 45,000 amortization, you're going to have to add it. So that becomes 495,000. Okay. Now let's answer the question. They want to know in item number 7, what amount should be reported as the interest income? The amount that should be reported as the interest income. Now, this is the interest expense. But remember, this could also be interest revenue or interest income. Because whenever someone has a note payable, that's the same thing as a note receivable, and you still have the same type of accounting. So the accounting is the same thing for a note payable as a note receivable. It's just note receivable, you're going to be receiving the payment. Note payment, you're going to be making the payments. So here, the interest expense is exactly the same as the interest revenue, which would be the $45,000. So the correct answer then for number 7 would be B, like Barbara, $45,000. Now there's 3 questions they could ask you. They could ask you, number 1, what is the amount of the interest expense or interest revenue? The amount of the interest expense or the interest revenue is going to be $45,000. Number 2, what is the ending balance in unamortized discount? The ending balance in the unamortized discount is going to be $105,000. Number 3, what is the carrying value of the note? The carrying value of the note is $495,000. Now let me show you how I got the ending balance of the unamortized discount. In this case, if you have a notes receivable, you have note receivable at the face amount. The face amount is $600,000. Then you can see that the note receivable at its carrying value is going to be $495,000. $495,000. And this is then going to be the discount on the notes receivable. So 600 minus something gives you $495. That's going to be the unamortized discount on note receivable of $105,000. So once again, the 3 questions they can ask you are, number 1, by the way, wouldn't it look exactly the same way if it was a note payable? Instead of having the word note receivable here, I'd have the word what? Note payable. It'd say note payable, face value $600,000. Discount on note payable $105,000. Carrying value of note payable $495,000. Exact same thing. Remember, someone has a receivable, another person has a payable. So the 3 questions they could ask you are, number 1, what is the amount of the interest revenue or interest expense? The interest revenue, interest expense for period 1 is $45,000. Number 2, what is the ending balance in unamortized discount? The ending balance in the unamortized discount is $105,000. Number 3, how do you carry the note? How do you report the note on your balance sheet? You report the note on your balance sheet at its book value or carrying value, which is $495,000. Okay? By the way, where would you show the interest revenue or the interest expense? On your multiple step income statement that I showed you on page 128 of your textbook. The interest revenue would be shown in plus other revenues and gains. The interest expense would be shown in minus other expenses and losses. Okay, depending on whether you had an interest revenue or interest expense. And interest revenue would be for a note receivable, and interest expense would be for a note payable. Once again, interest revenue is shown in plus other revenues and gains. Interest expense is shown in minus other expenses and losses. Okay? All right. Now that's under APB number 21. So then I want to show you a couple other multiple choice. We're going to do number 23, 24, 25. In this case, we're going to have the fair value election under standard number 159. Numbers 23, 24, and 25 are found on page 342. Okay, on page 342, let's take a look at numbers 23, 24, and 25. Number 23 says, in its December 31st, 2009 financial statements, I'm looking at number 23 on page 342. On its December 31st, 2009 financial statements, what amounts should be presented for this note? Okay. On July 1st of 2009, the Marceto Corporation borrows $100,000 on a 10% 5-year interest-bearing note. At December 31st, 2009, the fair value of the note is determined to be $97,500. Marceto elects the fair value option for reporting its financial liabilities. Remember, they can make this fair value option, they elect it. It's a fair value election. But remember, once they elect it, it is irrevocable. It's irrevocable. On its December 31st, 2009 financial statements, what amount should be presented for this note? Okay. Well, first of all, you're going to report the note at fair market value, which is $97,500. So the answer is down to either B, C, or D. It's B, C, or D. Now, originally it was at $100,000, and then we wrote it down to the $97,500. So we would have a loss. Okay, we have a loss. All right. So we have then the fair value of the note. We have a gain. We have a gain. The reason that we have, it's not a loss, it's a gain. The reason we have a gain is originally we had, let's just say debit cash, credit notes payable, $100,000. Okay, $100,000. Okay, and then what happens? I'm going to have to write down that note by debiting the notes payable. All right, for $2,500 and crediting a gain for $2,500. So that way now my note payable, which originally was $100,000, I debited it for $2,500, and so now my balance is the $97,500, which is the fair market value, and that's what I have to report on my balance sheet. All the gains and losses are put on the income statement as part of income from continuing operations. They would go in plus other revenues and gains for a gain, or minus other expenses and losses for a loss. This would be a gain because you're decreasing liability, which becomes a gain. So we're then now down, but first it was originally B, C, or D because they had $97,500 for the note payable. We see then it's going to be a gain for $2,500, so now we're down to either B or C. Now we have to figure it out based on the interest expense. Well, the amount of the interest is 10% on $100,000. Where 10% on $100,000 is $10,000. But the thing is, when did they borrow the money? They borrowed the money on July 1st. So from July 1st to December 31st would only be 6 months out of the 12 months. So even though the interest expense for 1 year would be 10% times 100,000, which is 10,000, you only take 6 months over 12 months of that, so the interest expense would be $5,000. So the correct answer would be C. The interest expense would be 6 months over 12 months times 10% times 100,000, so 6 months over 12 months of $10,000 is $5,000. The note payable would be reported at its fair market value of $97,500, and you would have to show a gain. Remember, when you initially reported the note payable, we wrote down the note payable by debiting the note payable and crediting gain for $2,500, so we have a gain. So the correct answer there would be C. All right? Let's take a look at number 24. Number 24 says, at what amount should Connor present the note on its December 31st, 2009 balance sheet? So they want to know what amount should they present the note on its December 31st, 2009 balance sheet. On January 1st of 2009, the Connor Corporation signed a $100,000 non-interest-bearing note that's due in 3 years at a discount rate of 10%. Connor elects to use the fair value option for reporting its financial liabilities. Okay, if you elect the fair value option, remember that option is irrevocable. On December 31st, 2009, Connor's credit rating and risk factors indicated that the rate of interest applicable to its borrowings was 9%. So 1 year has gone by. The present value factors at 10% and 9% are presented below. At what amount should Connor present the note at December 31st, 2009 balance sheet? Until you're telling me probably, well, Cindy, you just said that you're supposed to ignore the time value of money if they select the fair value option. Well, not necessarily. When you select the fair value option, you have to put the note on your balance sheet at fair market value. That's standard number 159. But remember, standard number 157 says there are 3 ways to value the fair market value. The 3 ways to value the fair market value are the first technique, which is level 1, which is a market technique, which is like a quoted market price. The second technique, which is the cost method, which is to have it valued something similar to yours, okay, like a Kelley Blue Book value for like a car, all right. The third technique, that was a cost technique, that's level 2. The third technique or third approach or third method is going to be the income method, where you take the present value of the future cash flows. Okay, that's a third method. That's level 3. What we're going to have to do here is use level 3. Okay. Now, at what amount should Connor present the note on his December 31st, 2009 balance sheet? Okay. When we elect the fair value method, we just use the fair value interest rate. They say that since we elect the fair value option for reporting our financial liabilities, we say on December 31st, 2009, our credit rating and risk factors indicate that the rate of interest applicable to our borrowings is 9%. So the fair value interest is going to be 9%. The present value factors at 10% and 9% are presented below. So what you're going to do is you're going to take the present value of the future cash flows, but instead of using the original 10%, you're going to use the fair value interest, which is going to be the 9%. Okay? This takes into account their credit rating and their risk factors. Not only that, 1 period has passed by. We started doing this at January 1st, 2009. It's now December 31st, 2009. That's 1 year later. So instead of having 3 periods, we now only have 2 periods left. So what you're going to do to calculate this is you're going to use the present value factor of 9% for 2 periods, which is 0.842. Once again, you're going to take the present value factor for 9% for 2 periods, because 1 year has ticked by, you only have 2 years left, so that's 2 periods, and you're going to use the fair value interest rate, which is a 9%. So that's going to be 0.842. What you'll do is you'll just take the 100,000 times 0.842, where the interest rate is 9%, which is the fair value interest rate, and the number of periods is equal to 2 periods, because 1 period has already ticked by. That's going to give you 84,200. And remember, this is a level 3 measurement, where you take the present value of the future cash flows. Okay, these are non-observable inputs, and you have to do this because they don't give you a level 1 measure or a level 2 measure. So you have to use a level 3 measure. So, at what amount should Connor present the note on his December 31st, 2009 balance sheet? The answer is $84,200, so the correct answer there would be D, like David. Multiple choice number 25, last one. At what amount should the discount on notes payable be presented on the balance sheet at December 31st, 2009? At what amount should the discount on notes payable be presented on the balance sheet at December 31st, 2009? On January 1st of 2009, the London Corporation borrowed $500,000 on an 8% non-interest-bearing note due in 4 years. The present value of the note on January 1st, 2009 was $367,500. London Corporation elects the fair value method for reporting its financial liabilities. On December 31st, 2009, it is determined that the fair value of the note is $408,150. At what amount should the discount on notes payable be presented on the balance sheet at December 31st, 2009? The correct answer is here. Guess what, folks? 0. The reason is because when you have the fair value method, no discounts, no, none of that. No amortization, no, none of that. Interest, just use the cash basis. All right, just take whatever's the interest rate, multiply it by the amount of the principal. That's what I would do. Okay, and then you might have to accrue it, okay, and prorate it. Like we did have to prorate it in item number 23 and multiple choice number 23. We just prorated it. But there is no discount. There's no amortization. There's no amortization schedules. Remember, you might have a unrealized gain or loss. The unrealized gain or loss goes as part of income from continuing operations, all right, in plus other or minus other. All right. So when they ask you what amount of the discount on notes payable should be presented, the answer is 0. So the best answer there is D, like David. Now, under APB number 21, you would have to do the whole amortization, and you would have an ending balance in the discount, like I showed you when we did multiple choice question number 6, and I told you how to calculate the ending balance in the unamortized discount. But that does not apply in multiple choice number 25, because here we choose the fair value option, so there's no discounts. I know this is more that you have to learn, okay? It is more that you have to learn. Believe me, it's more that we all have to learn. Accounting is unique. Financial accounting is changing just about every single day, all right? They could have started testing this last year, but we never saw multiple choice questions until this year. So what does that usually mean? If they start showing the multiple choice questions in the books, you got to know it. So that's why I showed you all 3 of them, number 23, 24, 25. Know how to do those problems. Also, know why it's tricky in number 13 on page 341. Know why you don't have to use the present value there. The reason you don't have to use the present value there is present value only counts whenever you go beyond 1 year, okay? And also, remember, standard number 159 is an election. You have to elect that. So they have to tell you they elect the fair value option under standard 159. They have to tell you that in order for you to apply the fair value method, okay? All right, then I will see you then next in module